India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Tuesday morning, a day before middle of the week market holiday. I'm Prashant. With me, my colleagues Nigel and Reema is with us here today as well. Guys, good morning.
Hi, and 1 week to go for the budget.
Yeah.
Same time next week, Tuesday morning, we will be talking about the budget. All set for it.
Well, that's right. And I don't think we have a holiday tomorrow, Prashant, but we have something special for our viewers, which we'll be getting. So no off tomorrow, but plenty of market action. So let's get straight to that.
Well, we can tell them watch from home.
But exactly, but our viewers can stay home and and we'll sort of tease that out for you in terms of what we've got lined up tomorrow morning for you. It's a special program. It's a market town hall, and more on that in a bit. But as always, let's begin with what you need to know as we begin another session. You got a broader. Yesterday's rally was broad-based, broader. I mean, not really broad-based, but broader as compared to like a one-trick pony that we had on Friday. The one pony was, of course, the IT sector on Friday, but that was such a large move that it kind of really eclipsed everything else, weakness in everything else. But yesterday it was, this and that and more, not just one sector. But I think PSUs was a common theme across oil and gas and, banks. And actually the PSU Bank Index was the top sectoral gainer. And many more stocks joined the party in that sense. So it was a solid start of the week with about 1/3% gain in terms of the session. Now, we were all, of course, watching out for the Powell interview with David Rubinstein last night, and it came through. And if you really want to pick out 2 or 3 things, it is that he said inflation prints, and I quote, do add somewhat to confidence that inflation is returning to target. But he did not really open the door for a July FOMC cut. And markets were not expecting it, although some were saying that maybe because, we've got 3 data prints which have been soft, which have been dovish. Well, who knows? The first cut in terms of market pricing is already still in September. So he's not really guided in a specific way in terms of a timeline for a cut, but he's kind of course, maintained that we are on that road. So it's not a question of if, but it's a question of when. And I think we'll get to hear more, of course, around the FOMC meeting itself. You also, of course, have the Republican convention going on. Essentially, it's the Republican Party in the U.S. Coming together to elect their presidential nominee. I mean, of course, that's Donald Trump. There is no 2 ways about it, especially, of course, after the incident over the weekend. But he's, of course, picked his vice presidential nominee, which is, J.D. Vance. He's, of course, seen as a bit hawkish. So we'll have to see what the market makes of it. But as I've been saying, it's too early. Elections are in November. And you're kind of sort of building onto it. I think the early indications, of course, are showing through in rates, are showing through in the dollar, which has also picked up a little bit on the upside. So I just come to markets and what they did. Equity markets were higher. NASDAQ about 0.4% up. You have 10-year yield, which was about 4 basis points to about 4.23%. Dollar index has been absolutely flat at about 104.26. Oil prices again flat, just under $85 a barrel mark. Now, just to circle back to levels here, you are higher. And I think one new element is that over the last 2 days, of course, you've got to sort of temper this with and make the nuance that there are lots of blocks. I mean, not now, but there have been lots of blocks, etc. But the point is, I think July, we are on track for July being a sizable month in terms of FII buying, and especially so as compared to what DIs have been doing so far this month. I mean, I think it's not been since December of 2023 that you have a month where FIs have outpaced DIs in terms of buying in the market. FIs actually have been sellers or small buyers, more like it. So let's see. I mean, we've got the budget, etc. So it's important. But so far, FI is outpacing what locals have done. Nifty, the important support stands at the 20-day moving average. Of course, there's enough distance now. 24,050 is that level. On the upside, the targets are the daily upper Bollinger Band, which stand at about 24,791. Extensions put the level for the Nifty at about 25,500. But before that, it's the daily upper Bollinger Band, which is that number on your screen. On the Nifty Bank, we closed higher. It was a much better session as compared to Friday, because Friday, of course, the market just sold. The Bank Nifty sold off completely. But even with yesterday's higher close, we traded within Friday's intraday range, within the highs and the low of Friday. For the Nifty Bank, a break above the high of 53,357 will confirm upsides, and supports for the Nifty Bank come in at about 51,750. So sort of near-term, short-term levels that we are watching out for. GIFT Nifty will come up on your screen, indicating a 18-point upside. I think it could be a market for stocks rather than a big move really coming through on the index. So we'll track markets as they open. Rima.
Well, let's just once again put the spotlight on the flows picture, because yesterday the FIs net bought 2,684 crore in the cash market, the second big day of buying. And now in the month of July, the FIs have nearly bought 13,500 crore of cash. The FIs sold yesterday, the second day of selling DII sold yesterday, second day of selling, but the selling was not much, just about 331, and much lower than the Friday's selling figure, which was about 1,650 crore. Though for the month of July, the DIIs are positive net buyers to the tune of 4,500 crores. So far, both the FIs and DIIs have given inflows in the cash market in this month. So today you've got the Nifty Financial Services and the Nifty Bank's weekly expiry. So the action could be hot in the last 1 hour. And in earnings today, Bajaj Auto, L&T Finance, Just Dial amongst the prominent ones. But you also have Century Textiles, DB Corp, Network 18 and TV18, whose earnings will be out later today.
Well, it's going to be an exciting session because the Nifty is making those strides towards the 25,000 odd mark. And today we have 2 weekly expiries, so we'll get to that in just a bit. What did the FIs do in yesterday's trading session, though? They added some long positions, and they have done that for the second day running. So they added more than 15,000 contracts on the long side in yesterday's trade, and they mildly covered some shorts of around 3,000 contracts. That takes the long exposure to around 80% odd. How are they positioned, though? The FI long positions, remember, it was holding at around 3.85 lakh contracts. The net long positions, well, that gradually came down all the way till around 3 lakh contracts. And now in the last couple of sessions, we're back towards the 3.5 lakh contracts. So this market is missing out on the FI short positions. But for the time being, the cash market flows are good enough to push us higher. You'd like some shorts, though, to get into the system. What about the options data? Well, yesterday's trade as well, we did see a fair bit of writing. The 24,500 put, 24,600 put, both of them did see a fair bit of open interest built up, and the premium as well comes up for you on the screen. Now that resistance has moved up, because we did see some writing at around the 24,700 call odd, which would bring us to the levels. On the downside, the level of around 24,400, that was a bit of a resistance when we were moving up. Now that becomes a bit of a support. 24,350 to around 24,400. The options data as well suggests that the 24,350 level is important. On the upside, since you're seeing a fair bit of writing at around the 24,700 call, well, that's the data point to watch, 24,750 odd. As I mentioned earlier, there are going to be 2 important contracts, weekly contracts that will expire today on the Nifty Bank as well as the Nifty Financial Services Index. So for the second half of trade, you'll have a bigger move on the financials and the banks because of this factor. 2 stocks that I'm looking at for today. One is Vedanta, that long-awaited QIP. Well, that's going to be important. Before that, the Nifty Bank, that's quite important, because the 20 DMA is a little lower from here. The problem is that the 52,800 mark has been a bit of a resistance mark. So it's still holding above those levels. Getting to the stocks I'm looking at, Vedanta. That one saw a bit of a decline from the recent peak. It's close to around 10% off its peak. For the last 1 year, it's up by close to around 60% odd. Now this QIP has come about, and that's something that the street was waiting forward for. Can the stock start a fresh leg post this 6,000-7,000 crores that it's looking to raise? That's going to be important. So that's one stock. And the other one I'm looking at is Zydus Life. It's been a rank outperformer in this year itself. It's sitting at a fresh 52-week high. We'll have the MSCI announcement, the inclusion announcement that comes in August, but the cutoff date will be sometime in this week itself. So that's why there is some positioning out there. I'll keep an eye out on that because as per a Nuvama note, well, that is a borderline inclusion. So keep an eye out on both these 2, Vedanta and Zydus Life.
The other 2 borderline potential inclusion stocks in are OFS, Oracle Financial Services, and the other one is Emphasis. And Emphasis saw a fair amount of buying in yesterday's trading session, but this is, of course, according to the Nuvama note. Zydus Life, OFSS, and Emphasis are potential stocks. They're on the borderline, but they could get included in the MSCI. But let's get to the money market views then. Abhishek Goenka of India FX and Asset Management says after the latest US CPI print, which was the lowest in 4 years, The probability of a 25 basis points rate cut by September has now risen to 93%. He remains bullish on the US rates and bearish on the dollar. He expects the rupee to underperform in a weak dollar environment as the RBI may look to correct the rupee overvaluation. He says the rupee has weakened just 0.4% in 2024, whereas other Asian currencies have weakened anywhere between 1.5% to 6.5% against the dollar. He expects the USD-INR pair to trade in a range of 82.7 to 83.7 against the dollar over the medium term.
All right, well, we have Vishal Goenka also commenting on bonds. He says that with all key macro numbers like CPI, WPI, industrial production being higher, bond yields should face resistance at current levels. He says demand for fixed income is likely being driven by global investors. Currently, story from the US remains uncertain as well, with significant political and economic events ahead in the coming months. He expects the 10-year benchmark bond yield to trade between 6.96 to 7.01%.
Well, we have a lot of stock-specific action track for you today. We'll get to that in just a bit in our special Top 10 segment. We're looking at Vedanta, Geo Financial Services, Hudson Agro, Lupin, Century Textiles, and Pearl Global. All of them will be reacting to positive news flow. We have Paytm, Angel One, Unichem Lab, and IPCA Laboratories that will be reacting to negative news flow.
Okay, well, Robert Sokin is with us. He's global economist at Citi. Robert, great to have you with us here. Thank you very much for your time. Now, I just want to start with, of course, with what Powell said last night, and I'll get to that in just a bit, but just the US political scenario and how that has changed and whether US markets are paying attention to it, with some saying and some polls indicating that Trump is in the lead. It's still, I guess, early because elections are in November. What is do markets like it? Do stock markets like it and bond markets like it, or does one like it and the other not so much? Just your sense.
Yeah, great set of questions. And, you know, we've seen a lot of developments in the political cycle here in the U.S. with the unfortunate events over the weekend, and then with former President Trump picking his vice president pick today in J.D. Vance. And you've seen markets baking in a higher probability of a Trump victory in November. And where you've seen that reflected is you've seen things like the dollar moving up, rates. You've seen a response in rates as well. And you've seen a response in higher equities. Now, I will say that, of course, November is a far amount of time away. There are mixed signals throughout the polls. Most polls and most models suggest that Trump is likely to win, although it's still in many national polls and several models of the election say there'll still likely be a very close race. So I think markets are baking in a higher probability of Trump, and that's certainly the way the wind is blowing. But there's a lot of time between now and November, and it's still, by most measures, a fairly close race in the U.S.
Okay. Robert, hi, morning. Then let's get to the rate cutting cycle in the United States. What is your current expectation and how does it compare with what you were earlier anticipating?
Yeah, absolutely. And we've seen a lot of very interesting developments on the economic front where we've had much better inflation data over the last few months. And that has really given the Fed a window into starting to ease policy. Our base case for a while has been that they'll do the first rate cut in September. We felt that they'd have enough progress on inflation to start easing rates then. And I think that's broadly what I would take away from Powell's remarks and where I think the FOMC is at the moment, that they're unlikely at this stage, even with the progress that they've seen, to start cutting rates in July, but they'll use the July meeting as a method to signal that they'll start cutting rates in September. Now, after September, I think becomes the even more interesting question. Our U.S. team is still expecting the U.S. economy to slow down significantly as we go into the rest of this year, and that would lead in their forecast to successive rate cuts at every meeting after the September print. Most people, though, think that they're going to go slower than that. Certainly the data feel, I think, still more like a soft landing than a recession scenario. And in that soft landing scenario, the Fed would probably cut in September, probably cut one more time at the end of the year, and then maybe a few times next year, depending on how fast inflation falls. So I think September seems very likely at this stage, but the path after that will depend on the growth rate of the economy, the health of the labor market, and progress on inflation.
So, Robert, just to talk a little bit more, how slow does the U.S. economy grow from here on for Citi to expect successive rate cuts after September? Are we talking about a recession? What is it that you're expecting?
Absolutely. Our U.S. team still has a recession in the second half of the year, and I think that is what it would take for the Fed to move as rapidly as they have in their forecast. Basically, a moderation in growth as we've had so far in the second quarter, that is not going to be enough for the Fed to move that rapidly and start cutting rates at every meeting. What you would really need is a sharp slowdown in the economy, a sharp deterioration in the labor market, so recessionary-like conditions to get that path. As I mentioned, the data are not feeling that way to me, in my view, at the moment. I think it's feeling more like a soft landing still, although recession risk has risen in recent months. And if you are in that soft landing, I think most people would say you would get 2 cuts this year and a few next year. So I think to get to that path, as you mentioned, you would really need a recession for the Fed to start acting aggressively and cutting in every meeting. And if you were to get that recession, it's not impossible the Fed would start cutting at 50 basis points a meeting or something larger. So I think if you get to a recession, all bets are off. But if you don't have that recession, I think you're likely to see a very gradual pace of rate cuts from the Fed.
All right. Hi, Robert. Good morning and good to see you. Ben, very quickly, before we let you go, what's the view on the Indian markets? You've been quite bullish. You've been saying that India is going to be well-placed, irrespective of whether we have a coalition government as of now. But at some point of time, valuations will play a bit of a catch-up. It doesn't look like, at least as of now, how you placed on the Indian markets.
Yeah, absolutely. And we've talked a lot throughout the last several months about the Indian economy, and I've always highlighted that it has continued to surprise us to the upside. And we've seen that very recently with continued strength in the economy. It was one of the best performers last year. It continues to be one of the best performers this year and still holding in at very high growth rates. And a lot of that risk that people were worried about in terms of economic policy after the recent election doesn't seem to be materializing. That still seems to be a policy mix that will be pro-growth, potentially even more pro-growth than it was prior to the election. And so I think it's a very positive story. And then we've talked about many of those other longer-term factors that support India, like much more favorable demographics than other emerging markets and certainly than other developed markets. And so I think, as you said, the valuations have looked high for some time, but they've continued to attract investor flows, and you've seen continued strength in those markets. So I think, again, it still is a very attractive place for investment. I think it's going to continue to be an economy that performs very well and probably continues to surprise us with its resilience.
All right, Robert, we'll leave it there. Great conversation as always. Thank you very much for your time. Appreciate it here on CNBC TV18. Well, we'll take a break here. Just a quick programming note, and this is what we were talking about, tomorrow and what we've got lined up for you. So, we've got a special offering, a very special offering at 9 a.m. tomorrow. That is Wednesday, a big CNBC TV18 exclusive. This is just ahead of the budget, remember. One of the world's top market strategists in our studios, Chris Wood of Jefferies, will make his bull case for India. Don't miss out an exclusive chat between Chris and D Street stalwarts like Ramesh Damani and Utpal Seth. All this and more on Wednesday, that is tomorrow at 9 a.m. Only here on CNBC TV18.
Welcome back. Yesterday was a strong start to the week. The benchmark indices closing at record highs for the second day in a row. Yesterday, Nifty sensex ended up with a gain of 0.3%. The Nifty closing below 24,600. But this morning, The GIFT Nifty is suggesting a slightly positive start and could push the spot Nifty above 24,600. The PSU stocks were the stars in yesterday's trade, and mid-caps too continued with that record-breaking rally. But let's drill it down to the individual stocks. Our entire research team is standing by with CNBC-TV18's list of top stocks for the day. And first up, it's Vedanta. That's the big one to watch today. Sudarshan?
That's correct. So last week of our CNBC-TV18 news break is confirmed as per the term sheet that we have an access to. Vedanta has launched the QIP to raise up to nearly almost rupees 6,700 crore, and base size is a little more than rupees 5,000 crore, and with the green shoe option is almost rupees 1,700 crore. Indicative price is seen somewhere around 440 per share. If you consider yesterday's closing price, it's at a discount of little more than 4%. And at the base price, there will be a dilution of 3% equity, and if we consider the total size, it would be a dilution of 4%. So in the last 1 month, this will be the second time there will be a dilution in Vedanta. Last month, Vedanta's promoter had sold 2.6% equity via block this. And after this QIP, there will be a lock-in period for both company and promoters of 60 days. So keep an eye on Vedanta. The stock will be in focus today.
And congratulations, Sudarshan. You told us first here on CNBC TV18 itself. I think this is a big trigger because it'll keep the debt under check. And then the street moves ahead and, in fact, looks at, how the demerger pans out. But congratulations on that big story. Well, let's hop across to Abhishek. He's standing by to tell us about Jio Financial as well as Paytm. Morning, Abhishek.
Morning, Nigel. So, Jio Financial, other income has aided the top line growth this time around. If you take a look at the interest income, it's down 16.8% YOY and 35.8% sequentially. However, other income is up 25% YOY and about 104% sequentially. The OPEX has been controlled, and that's down by 22% on a quarter-on-quarter basis. Operating profit, hence, is up nearly 7% on a sequential basis, while PAT is nearly flat on a sequential basis. Now, Paytm administrative warning letter from SEBI has come in for related party transactions entered by the company and its subsidiaries. So this was done in FY22. Company had claimed that the transaction do not qualify as related party transactions during FY22. However, the board and audit committee have considered as material related party transaction and passed a resolution that such transactions with PBPL will be within the limits. Now, violations have been viewed very seriously by SEBI, and they have warned Paytm to be careful in future and improve the compliance in Paytm. Back to you.
Right, Abhishek, thank you very much for that. Now, Angel One reported numbers, and Vamakshi is here to tell us how they look. Vamakshi, morning.
Well, good morning, Prashant. Let me first start off with the company's operating revenue. That stood at 1,405 crores. This is an uptick of almost 4% sequentially. And this growth is largely being led by interest income, which was up 19% on a sequential basis, and other income. Fee income, which contributes a major portion of the company's revenue, was, however, flat on a sequential basis. The negative this time around was the growth in operating expenses. This growth in operating expenses was much higher as compared to the top line growth. In fact, operating expense reflects 115 crores a portion for IPL expense. The employee expenses too were nearly 27% higher quarter on quarter, led by annual increments and variable pay. Resultantly, we're seeing a nearly 11% dip sequentially on the EBITDA. EBITDA now stands at 470 crores for the first quarter, and the margins have also contracted sharply, down nearly 560 basis points sequentially to 33.5%. Net profit is also seeing a downtick of nearly 14% sequentially. So overall, that doesn't look like a good set of numbers for Angel One, and my sense is the stock is expected to open lower today.
Okay, big 115 crore of IPL expenses could drag Angel One lower today. But let's get to more earnings. Mangalam joins in with Hudson Agro. Mangalam.
Good numbers coming in from Hudson Agro. You have around a 10.5% revenue growth that the company has reported. Remember, this was the summer season, extended summer as well, at a time where they're increasing their footprint in the ice cream business. So that's done well for them, and that's reflected in their gross margins as well. So 10.5% revenue growth has actually led to a 39% jump in their EBITDA, which has increased from about 11% to 14% on the margins. And as a result of which, there was a sharp 62% jump in the net profit as well. 80 crores have turned into 130 crores. And gross margins, like I said, in the dairy business, the cycle is turning. So most companies will report quarter-on-quarter gross margin decline. But here, both quarter-on-quarter and year-on-year, gross margins for Hudson Agro have increased. So see green on the stock.
Okay, thanks for that, Mangalam. Good set of numbers coming in there on Hudson Agro. But let's get our daily dose of pharma. Ekta joins in to tell us about some of those pharma stocks that are in the news. Ekta?
Thanks for that. Well, I'll start with Lupin, which I expect the stock to be in the green today because they've divested their US commercial women's health specialty business to EvoFem, which is a biopharma company focused on women's health. Now, basically, this women's health portfolio contains one of their key brands called SoloSec, which they had launched a couple of years ago. It's a single dose drug, which is basically used to treat two sexually transmitted diseases. And it was expected to have a lot of potential, but I think the ramp up was slower than anticipated. But from this deal, Lupin can receive a potential of up to $84 million based on future contingent milestones. The aim is to build a few therapeutic areas in the US which have synergy, such as respiratory as well as neurological. So that stock will be in focus on account of that. Unichem is in focus along with Ipca because Ipca bought Unichem because Unichem's Goa plant has been issued 5 observations. The observations, they say, are procedural, no data integrity.
All right, Ekta, thank you very much for that. Well, let's talk about real estate as a space. Century Textiles should be in focus. There is also Pearl Global, which we want to highlight. Sonal has got both those on her radar. Sonal, morning.
Good morning, Prashant. Let me start with Century Textiles. Birla Estates, which is an arm of the company, has secured prime land of 71 acres. This is in Sector 71 of Gurugram, which is a prime area. The gross development value here is 1,400 crore rupees. The development potential is of around 1 million square feet. The second stock on our radar is Pearl Global. They will be raising funds via QIP. They have approved the floor price of the issue at around 748.68 rupees per share. Additionally, there is a block deal here in this stock as well. HDFC Mutual Fund bought 6.8 lakh shares, which is 2% of the equity via block deal yesterday. This is something that Nimesh had highlighted on the Street Charter yesterday as well.
Okay, thank you very much for that. Pearl Global ending with a gain of 3.5%. A quick recap then of the top stocks. Stocks with positive news flow are Vedanta on the back of that QIP, Geo Financial Services, Hudson Agro, Lupin, Century Textiles and Pearl Global. While stocks with negative news flow are Paytm, Angel One, Unichem Laboratories and Ipca Laboratories. We also have Vodafone Idea, which should be on your radar, but we'll get to that in just a bit. Before that, it's over to Manisha for all a roundup of the commodity action from overnight. Manisha.
Thank you so much for that. I'll start with the crude oil prices, where we have seen some pressure come into the markets, and this is because of the slowing Chinese demand. The crude imports into the country have been weaker, and we've seen the GDP numbers and the employment, retail sales, all of that data come in on the weaker side here. But the markets have kind of reacted to the U.S. Fed Powell testimony, saying that they will not wait for the inflation rate to hit 2%, and that really has increased the probability of an interest rate cut coming in for the month of September. It has given a lot of surge for the precious metal prices overnight, where gold is now very close to its all-time highs. We have seen last 3 weeks of gains come in for gold, and further gains is what we are looking at this point in time as well. Well, it also has to do with the China plenum meeting. Well, that is underway, and expectations of further stimulus measures and policies for the next 5 years from China is what is the market's waiting for as well, and that in turn seems to be supporting the metal prices also. So it really is about metals in Asia right now, which are trading quite in the positive.
Thank you very much for that. And now let's get to the macros. India's goods trade deficit has narrowed to $21 billion in the month of June versus $23.8 billion in May. This was largely due to a fall in oil import data. How should we read and analyze this data? Lata joins in for more. Lata.
Well, actually, it's a very predictable and pedestrian set of numbers. The standout part is the export growth, which we thought was really going to about 38-40 billion a month, which is what it showed in May. Actually, it turns out to be a one-month wonder, and we are back to our 34-35 billion per month. So it's a 2.5% rise year-on-year for exports, about a 5% rise year-on-year for imports. The big reason, as you said, why the trade deficit has come down, the goods trade deficit, is because the oil import bill is remarkably lower. But this is, just 1 month you import more, so you import less in another month. It's about $4 billion less at 15 billion compared to nearly 20 billion that was the import bill in May. But, when the import amount is less, the export amount, we export about a third of what we get as imports of crude as, specialty products. So crude specialty products exports also fell because the total amount of crude imported fell, and therefore the deficit has actually declined. The engineering exports, electronics exports, and drugs and pharmaceuticals. These were the three guys which led from the front with very big export numbers, but all of them were not as good as May. May was a really wonderful month when it comes to exports. Imports, again, electronics, because a lot of what we import, we repackage and export. So electronics imports are very high. Oil, I already told you, is a big number, though again, it's much less than May. Machinery has done extremely well in terms of imports, indicating that probably the Indian industry is well and kicking, accounting for a goodish bit of machinery exports. In services, again, nothing much to report. It's a 10% higher export bill and a 10% higher import bill. So the services surplus is about 13 billion. The overall deficit for the month, if you deduct the goods deficit from the services surplus, it's about $8 billion. Very par for the cause. So nothing outstanding except that, the big rise in exports in May has not been repeated in June.
Right, Lata, thank you very much for that. So that's putting the trade data in some context there. We'll take a break here. On the other side, we have Siddharth Khemka of Motilal Oswal Financial Services. We dive into stocks and what are the trades and positions you can take this morning. Stay tuned.
Welcome back. Hope you're having a good morning. Siddharth Khemka, the head of retail research at Motilal Oswal Financial Services, joins us on the show. Hi, Sid. Good morning and good to see you win. Well, the top stock today could be Vedanta. They've come out with that QIP. If they can raise that, that say $600 million that they're talking about, which could probably be yes, given the kind of time that we are in the cycle. The Fed could cut rates. That'll soften the dollar index and in turn help base metal prices. What's your view on the stock? It went all the way to around 500 plus, and then it saw more than a 10% correction from the top. But once the QIP is in, the promoter selling doesn't come about, and it opens the it helps the financial matrix as well. Your view at 460?
Yeah, good morning, Nigel. Glad to be on the show. So yes, I think Vedanta keeps coming up with some of the other news developments and on the news flows. So this time the QIP, they had earlier taken the shareholders' approval to raise up to 1 billion from equity issuance, and then I think this QIP is in line with that. For this financial year, their debt obligations repayment is in excess of 1 billion. Last year, they did a dividend payment of almost 18,000 crores. So somewhere the maths, cash flows needs to match. And as you rightly said, yes, the Fed rate cut around the corner will be definitely positive for the metal companies, and the stock has been doing well. If you see the last quarter numbers has been pretty steady. This quarter also we are expecting a steady quarter. At the current valuations, I think the QIP definitely helps manage the cash flows. There will be less pressure on the internal accruals. And going forward with the company also having taken approval for demerger into 6 separate units, this will be, I think, at least in the near term, very positive. So we have a target price of 520 and a neutral rating, but we see this QIP as a positive development in the near term.
Siddharth, morning. Do you look at Angel One? It's been a big beneficiary of the financialization of saving India's equity boom. But the last couple of months, Angel One hasn't participated in the up move. Year to date, the stock is down 35%. And now even the Q1 numbers, they're not great. Profits are down 14% on a quarter-on-quarter basis. Thoughts on Angel One from here?
Yeah. Good morning, Rima. So if you see the results have been pretty strong numbers have been pretty strong. The entire broking industry has been getting record volumes, and the same was with Angel One. Especially if you look at strong growth in both F&O as well as cash segments. The gross broking business has grown 65%, F&O 65%, cash segment 81%. The key concern here is that there are regulatory overhang on this sector right now. There are talks of how SEBI wants to curb the tail end of the F&O trading, which in India is among the highest globally. And that is something, as I said, is a kind of an overhang on the sector. We have seen a lot of regulatory changes, a lot of regulations on the capital markets, but the volumes continues to surge. So we believe that the near term there could be pressure until clarity emerges on the way forward in terms of the lot size, the margin requirements, even the overhang on the taxation on the capital gains in the upcoming budget. So these things are keeping the capital market stocks a bit on the cautious side. But bearing that, we believe the capital market theme in India and the financialization of savings would continue to grow, and that should do well over the long term.
But right now, there is a bit of a regulatory uncertainty. Siddharth, do stay on. We want to talk about the telecom space. Now, yesterday, Vodafone Idea moved up 3.5%, and that up move came in the second half of the trading session. Now, the company has sought an urgent hearing of its curative plea against Supreme Court's 2019 judgment. The company in its plea has cited arithmetic errors and sought a reduction of its AGR dues. We have with us Balaji Subramaniam, Vice President at IFL Securities. Balaji, before we get to the impact on Vodafone Idea, first for our viewers, give us a little bit of a background, a simple background of this curative petition of AGR dues that Vodafone Idea is seeking.
Hi, good morning, Rima. Thanks for having me on the show. So the AGR case runs all the way back till 2005-2006, and the crux of the disagreement between the government and the telecom industry has been, how the adjusted gross revenue is defined. So that dragged on in courts for a long time, and in October 2019, the Supreme Court came out with a verdict which was against the industry, and it asked all players here. One needs to note that Jio, by virtue of being a late entrant in this sector, was not impacted by this legacy case. So this said that Bharti, Vodafone Idea, and even many of the telcos who had stopped their operations, they had to pay a pretty hefty liability to the government, which not only included the actual dues, but also the interest penalty and the interest on penalty. So after that, Bharti made an upfront payment of around 18,000 crores. Vodafone Idea made a payment of around 7,800 crores. And at the same time, they also appealed against this verdict. In September 2020, the Supreme Court, again said that, again ruled against the telcos, saying that, there would be no relief on this, and, whatever amounts the DOT has demanded cannot be subject to dispute. And it also asked the telcos, at least it gave some leeway in terms of cash flow, where it said that the telcos can make this payment over a 10-year period ending March 2031. So, there was some cash flow relief, but at the same time, about 8% interest was also levied, so that the government did not lose in present value terms. So sometime in late 2021, the telcos considered submitting a curative petition against the September 2020 order, but again the Supreme Court declined to entertain it. Finally, in September-October 2023, the telcos again made an appeal, especially Vodafone Idea, and this time the Supreme Court had a more favorable bias, and it asked the telcos to submit their curative pleas, which the telcos duly did. But now it has been nearly 9-10 months after that happened, and there has been no clarity in terms of the timeline by which this would be heard, and that is where Vodafone Idea again went back to the court yesterday and sought urgent hearing, because it would especially add clarity in terms of their debt raising plans, which regarding which they have been in talks with banks and other financial institutions. So that is a brief background of where we stand as far as the AGR case is concerned.
Okay, thank you for explaining that so well, Balaji. Just some quick numbers. What are the current AGR dues, assuming the interest on penalty for Airtel and for Vodafone Idea? And secondly, what is the street expecting by way of a relief if it comes through? Say 50% of the dues are waived off. Then how does it impact the stock price? Is it already in the price? What would the target price rise for the two companies?
See, if you look at the public disclosures of Bharti Airtel and Vodafone Idea, Bharti Airtel has somewhere around 36,000 crores as the AGR dues. This is, including accrued interest, and this is the full number after what they have already paid the government in the past, etc. And the corresponding number for Vodafone Idea is around 70,000 crores. Now, I think the way it can pan out is that the Supreme Court allows the government and the telcos to kind of, sit together and resolve any calculation errors. And based on what Vodafone had done and Bharti had also done, it does appear that the relief can be to the tune of 50 to 60%. Of course, these calculations are very complex, going back across multiple years, across many circles, across all circles. But the rough extent of relief could be around 50-60%. So if one were to take a 50% relief as the number here, then we are talking about an NPV relief of nearly 35,000 crores for Vodafone Idea, which would probably equate to a little more than 5 rupees per share. And for Bharti Airtel, we are talking about an 18,000 crore relief, which would work out to roughly around 30 rupees per share. Now, that said, I think some of these are already being factored in by the market, because there have been some hopes of a relief coming on the AGR front. Now it will be very difficult as to how much of this 5 rupees and 30 rupees per share are already factored in. But my sense is that some bit of that is already factored in, while some bit of it can still play out in the market.
So, briefly, Balaji, what is your price target if there is if the relief comes through in the curative petition? Is there upside to your own target? And B, curative petitions are people appeal for them, but they're rarely taken up. So it's now the CGI has taken it up, and we're waiting for the date now. So in that sense, I think it's kind of raised hopes. So that's the way to look at it.
See, in my base case, I assume a 50% relief. So to that extent, my target price of 19 rupees for Idea and 1,597 for Bharti includes a 50% potential relief. If the relief is higher than that, there can be some upside. As far as the second question is concerned, even though curative petition pleas are rarely heard, and even more rarely you get a favorable judgment, my sense is that there is still some hope for relief, considering the fact that if you look at the September 2020 order, it also produces the affidavit by the DOT in the Supreme Court, which says that the estimates of DOT are based on preliminary estimates. So to that extent, the word preliminary at least indicates that probably, there needs to be some sharpening of the numbers. So I think it does offer some wiggle room. Of course, beyond a point, it becomes difficult to step into the shoes of the court and make such statements. But I think at least, that particular clause in the verdict gives us some bit of hope, but we'll have to wait and watch.
Absolutely. I think can't second guess the courts, but that's an important point that you make. and why I think many are hoping that that relief will come through. Balaji, thank you very much for joining us as always on these important issues. Appreciate your time here on CNBC TV18. Well, let's turn our gaze back to the market and what's in store for us. Anuj is here with the setup. Anuj, morning.
Morning, Prashant. And for me, the big cue this morning is the overnight statement by Fed Chairman Jerome Powell. Now, many people want to read it in their own way, but the market has decided to read it like a rate cut is coming on 31st July itself. But it was, of course, enthused by the statement. I think the biggest example of that was the Russell 2000 or the small cap index in the US that rallied 2%. Now, that normally is, of course, a bit of a rate cut hope rally. In any case, the Indian market has been way too strong, but a bit of a global help won't, hurt. So that's something which could help as well. And FIs have started to buy as well. For last 2 days, there's been big buying in the cash market. And that, I think, is, again, perhaps in anticipation of some kind of a rate cut. The market might want to price in a rate cut, even if it happens or not, by 31st July. The only risk to Indian market now is that you have a budget coming. And there's always this, rumor or some kind of a buzz whether something will happen to the capital gains tax or not. In terms of setup, FIs bought yesterday 2,600 crores. DIs have been selling marginally. FIs are buying daily in index futures, 1,330 crores yesterday and 4,800 crores in stock futures. The put call ratio has gone up a bit, but that happens in an uptrend, 1.33 versus 1.28. The market's overbought, but it has been overbought for last 1 month or so. In terms of levels to watch, the first support is 24,522, yesterday's low, and then the bigger support is 24,445 based on the option side. Resistance comes in at 24,635, the all-time high, and then 24,702 based on the options. The bank nifty is important. Keep in mind, today is weekly expiry of both financial nifty and bank nifty because tomorrow is trading holiday. So that's why today Bank Nifty could be in focus. You have an option writers range of 52,336 to 52,720. The quote for the day, it comes from Barbara Pletcher, and it is the real winners in life are the people who look at every situation with an expectation that they can make it work or make it better.
All right, Anuj, thank you very much for that. That's interesting as always. To get it every morning. Well, we'll take a quick commercial break here. Mitesh and Sudarshan will be with us with some technical trading ideas. There is 11 minutes to go for the pre-open session. Stay tuned.
Welcome back. Well, yesterday one of the big movers was Zomato because they're going ahead in increasing charges and in fact monetizing it. And now volumes as well are moving up. So that's why in fact that stock hit a fresh 52-week high yesterday. We're still in conversation with Siddharth Kemkar. Sid, what do you make of this one? In the last 1 month itself, the stock is up close to 25%. Last 1 year, it's up even more. Your view on the stock at these levels of 230?
Yeah, Nigel. So if you think, on the e-commerce platforms, they have started charging the platform fees and slowly and gradually ramping it up. So from 5 rupees to 6 rupees, that is almost 20% hike, which is a good percentage hike for the profitability of these companies. And it has been well accepted across the market. So I think that's a good step to improve profitability. And that is what the street was hoping and expecting for. Apart from that, if you look at Zomato, the quick commerce Blinkit has ramped up at a much faster pace than expected, even in terms of profitability. So view is definitely positive from here on. We believe that the penetration of e-commerce and the duopoly nature makes Zomato a very interesting case even at these levels because of the growth, improvement in profitability and the increasing opportunity in the Indian markets.
And if they didn't have enough triggers, I'm reading an article which states that certain states may allow home delivery of alcohol as well, via quick commerce platforms like Swiggy, Big Basket, as well as Zomato. So additional trigger if in case that's allowed.
Yeah,
okay,
yeah, I think that.
Yeah, go ahead, sir.
Yeah, So if you look at some of these e-commerce platforms did try to do home delivery in the times of COVID for the alcohol, and if that does happen by certain states, it will be definitely additional positive trigger, especially for some of the quick commerce companies. What I also read is, for example, beer and wine to be started with earlier. So it could be another 5 to 6% of the overall business opportunity for them right now. Given that still a lot of this alcohol consumption happens out of the home. So while it reads to be a good opportunity, I think the initial opportunity size could be smaller to start with.
By the way, Rima, you were talking about Angel One, I think, with Siddharth earlier, right? I was just reading the Money Control written a piece, basically comparing discount brokers, and I found it very surprising. The gap between Zerodha and Angel One is now very, very small.
In terms of market share?
Of active users.
Active users.
So, it's the chart over a 1 year period is exactly the opposite. Angel One has grown, and Zerodha's, the numbers, active users has come off quite a bit. Just another one of those things, but it's a space, it's not really what's of course influencing these brokers. There are not that many listed brokers, but there's Motilal, there's MK, there's Angel. From a broker perspective, is not, I guess, market share, etc. Right now, it's essentially regulatory risk, as Siddharth also pointed out earlier. Siddharth, just a few other names, and just throwing these your way. The Mazgaon, the Garden Reach, the Shipping Corporation, Cochin Shipyard, essentially shipping companies, they all came under some selling pressure, but they've all been such large outperformers all of this year, and I think over the last 1 year as well. What do you do with these if you have a position?
Yeah, it's a difficult call, Prashant, to be honest. While we don't have active coverage, these stocks have seen a massive run-up. And if you ask me, if someone has a 5-year horizon, I would definitely recommend to hold. There will be bouts of profit booking given the sharp rise, but the opportunity size is huge, is immense. The government's focus on making in India, spending on defense, and the newer trigger of exports, that is only adding to the overall growth opportunities. A lot of these companies are definitely adding capacities, but again, in the near term, there are two risks. A, the market is at all-time high. The stocks have seen a massive rally and run up, so definitely there would be bouts of profit booking in between.
All right. We'll leave it there today. So thank you very much for joining us. Good conversation as always. Appreciate it here on CNBC TV18. Let's talk about the oil and gas space. Quite a few developments to take and focus on in the sector. We have an analyst joining us, Dayanand Mittal, oil and gas and telecom research analyst at JM Financial Institutional Securities. Dayanand, good to have you with us here. Good morning. Thanks very much for your time. Before we get into some of the individual stuff, but just wanted to get a quick sense from a budget perspective. Should we expect anything for the oil and gas sector? Realistically speaking, there is, of course, with regards to gas, some conversation which has been brewing. We sort of quizzed the MGL management recently around those. Well, we hopefully something will come through. But your sense?
Yeah. So from budget perspective, obviously, gas sector is one space where there's a lot of expectation around providing relief or boosting the gas consumption story in India, given government has earlier announced plans to increase share of gas in India's energy consumption from about 6.5–7% currently to 15% by 2030. And this is being not happening at that pace because of the surge in global gas prices. So government is trying to find ways by which they can make gas more affordable domestically, either by way of including gas in GST, though may not be a part of the budget, given GST committee's authority will decide on this. But yeah, any indication from the finance ministry on during budget before that on what's the status, that would be key. Second thing, what is within finance ministry's domain is probably cutting the excise duty on gas from current around 14%, in case including within GST framework will take its time. So that could be a temporary relief before they can get all the states together to agree to include gas in GST. So that could be one big thing that is expected from the gas sector. Apart from that, I don't think there's much divestment. Oil ministry has ruled out, so nothing much there. Windfall tax, I think that might mostly continue. So again, I don't expect any changes on the windfall tax regime, given crude price is around that $80-85, which is decent, but not low from government's comfort perspective. Yeah, so that's the key expectation, I guess.
Hi there, Anand. Good morning and good to see you. When I wanted to focus on ONGC and Oil India, after a very long, they have come back, and in fact, both those two stocks are the biggest gainers in the last 3-4 sessions. Let's focus on ONGC because that was the big mover yesterday. We know valuation-wise there is comfort, dividend yield as well. We know the street is waiting for volume growth. What are you penciling in terms of volume growth for the next two fiscals? Because that's been lagging in the past, and the management I think is indicating a 5 to 6% volume growth. What are you penciling in?
Yeah, so both these stocks, volume growth has been a key structural concern for both the names, given the matured nature of oil and gas fields that they own, where you see a natural decline of 5 to 6%. So even they keep exploring new fields, that only goes to offset this natural decline. So overall production continues to be subdued. But after a long time, both the companies have few blocks which will contribute to growth. First, ONGC's KG-DW98/2 block, which has been long overdue, that will finally commission and ramp up from 3Q FY24. And that can probably add about 15 to 20% to ONGC's production over a three-year time frame. Given the not so great track record, we are conservatively building more like a 10% volume growth over a 3-year time frame for ONGC. For Oil India, there's a massive growth opportunity, but first on gas side, because of the new Indradhanush gas pipeline, which is gradually going to commission over next year or so, that as per management can increase the production by almost like 40-45%. But given the usual delays in pipeline, not so great track record, we have conservatively assumed probably they'll be able to deliver at least half of this in 2 years, and probably they'll get to what they're guiding over a 4-5 year time frame. For crude, Oil India, there's no block per se which is going to drive this, but yeah, there are a lot of IOR, EOR activities which they are doing, which can increase their crude production by about 10-15% over a 2-3 year time frame. So after a long time, we can see probably a 3-4% annual production CAGR over next 2-3 years. So that's the key story, apart from the fact that OPEC is keeping oil price high, which gives comfort on that $75 net crude realization. So yeah, these are the two key stories apart from dividend yield, which you mentioned.
So, the sector on the upstream side, is ONGC the pick for you, Dayanand?
So I would prefer Oil India, primarily because the volume growth story is much steeper in case of Oil India, something like a 40-50% production growth. In case of gas, if assume pipeline comes on stream, demand ramps up. And for crude, about 15-20%. So overall, about 30-35% production growth is possible in the next 3-4 years. For Oil India, for ONGC, that number is more like 15-odd%. So Oil India would be preference. Second key reason for Oil India's preference is they have 70% odd stake in NRL refinery, which is tripling the capacity from 3 million to 9 million tons. And there's a huge excise duty benefit being located in Northeast. And that excise duty benefit is likely to continue even for the expanded capacity. So they've got a huge, about $10-15 extra GRM which they make in this refinery vis-a-vis what the industry GRMs are.
On the downstream side, I mean, is there a case to be made to be buying any of these oil marketing companies?
So our preference has always been, we prefer upstream PSUs over OMCs. Primarily because we think oil marketing companies' valuations have gone out of the historical band. Historically, HP, IOC traded about 1-time price to book, BP around 1.2, 1.25. They're trading now at about 10-20% above historical averages. We have a sell rating on HPCL and IOCL, primarily we believe because last 2 years, FY23 and FY24, GRM were very strong because of a lot of supply outages and one-off factors. Though we expect GRM to be robust, but unlikely that those strong GRMs of FY23-24 is likely to be repeated. Second, on the marketing margin side, few in the street are building in bull case assumptions of marketing margin further rising from the historical levels. We see that as a key risk, given the weaker mandate for the current government, given crude price is likely to be around the 80-85 band, which is at the edge. Any spurt in crude could put marketing margin under pressure. And also the biggest structural concern on OMCs is the huge capex that they are laying. Though over a 15-20 year period, this might prove to be profitable, but in the near term, next 5-10 years, given the time and cost overrun, they usually tend to be value destructive.
Just one last brief question, and moving away from oil and gas. You track telecom as well, Dayana? And what's the pick there? I mean, there's this AGR news that we were discussing earlier with Balaji of IIFL. Quick thoughts there?
Yeah, so in telecom, our top pick is Bharti, Reliance because of Jio and retail. We have a sell rating on Vodafone Idea and a hold on Indus. Though this news, in case Supreme Court gives its verdict in favor of telcos, logically that favorable decision makes sense given the arithmetical error that was involved, and given the previous decision of Supreme Court was a bit harsh in terms of penalty and interest on penalty. So assuming this decision comes in Vodafone and Bharti's favor, for Vodafone, the debt relief could be in the range of about 35,000 crores, which is about half of their 70,000 crore AGR dues. So given the EV won't change, assuming no changes in assumptions, this 35,000 crore could translate to equity, which if I do a rough math, can add about 5 rupees to the target price. For Bharti, that number would be more like 20,000 crores. So given its huge size, probably is a 1 or 2% addition to its equity.
Got that. Diana, thank you very much for that. So any potential relief on the AGR dues can boost the fair value of Vodafone Idea by nearly 5 rupees. That's the word from JM Financial and IIFL. Just going mathematically. But it's 9:10. Time to get in the call from Sudarshan. Sudarshan?
Hello.
Hi. What's your 9:10 call?
Right. Sorry. Eicher Motors is a buy with a stop under 4,800.
Eicher Motors. Mitesh?
I'll go with a buy on Bajaj Auto for targets of 9,900.
Okay, all right. Thanks a lot for that, gentlemen. Well, let's get Sudarshan back in because he's the one who broke that story on Vedanta's QIP. And that's official right now. Sudarshan, tell us more.
So today Vedanta is opening with a gain of nearly 2% after the company's QIP is launched, and via QIP, company is looking to raise nearly rupees 6,700 crore. And out of that, base size is 5,000 crore and green show option is almost rupees 1,700 crore, and indicative price for QIP is rupees 440 per share, which is a discount of almost 4% against yesterday's closing price. Now, what will be the next trigger for Vedanta stock? So likely the next trigger is demerger details. Remember, in September 2023, company had announced that it will demerge the company into 6 listed entities, and it said Vedanta will be the majority shareholder of 17 investment vehicles post demerger. Also, as per the recent brokerages, JP Morgan has a neutral call on the stock with a target of rupees 395 per share. CLSA has an outperform call with a target of rupees 520, and Nuvama has a buy call with a target of as much as rupees 644 per share.
All right, so thanks very much and congratulations once again on that story. Well, HDFC AMC is the next one we're going to focus on, and there is a little bit of lift in earnings and sort of view coming through from brokerages. Vamakshi is here to detail that out for us. Vamakshi.
Well, HDFC AMC had reported numbers during market hours yesterday, and that was a strong set coming in from that company. We have a couple of brokerage notes. CLSA says that the company reported a strong Q1 net profit, which is up nearly 27%, and this was largely driven by 37% growth in AUM and sharp gains in investment income, which offset higher operating expenses. Share of equity rose, and as a result, yields expanded by nearly 2 basis points. The drags from NFO, that is a new fund offer on yields, were negligible, but the OPEX was elevated with NFO, KYC and ESOP related expenses. Nevertheless, given the strong earning momentum, they've raised their FY25 AUM growth, which leads to 3 to 5% increase in FY25 to 27 net profit estimates. And given that, CLSA has gone ahead, maintained its hold rating, but raised its target price on HDFC AMC to 4,450. Jefferies, on the other hand, has raised its estimates by almost 1 to 2% to factor in higher AUM and investment income, and they've gone ahead and raised the target price to 4,900. They've got a buy call on HDFC AMC.
All right, lots to track this morning as always. Vamakshi, thank you very much for that. We'll have the first rates coming up in just a bit from now, in the next 1 minute, less than 1 minute. We'll have the stocks, HDFC AMC in the pre-open. Maybe if you're able to put this up. I think it's a 30 rupee uptick on HDFC AMC. And the other one we just discussed, of course, is Idea. News flow related names, which I think is also starting about 5-6% higher. There is Angel One, which we will look at on the back of earnings which came through, and many others as well. But first rates on the indices, as always, what do we have? 24,600 plus on the Nifty. We've got the sensex, which is starting about at about 80,750 or so. So, you know, these are the very first rates which are coming through. What else is coming through? Nifty Bank is starting 100 points higher. That's 0.25% in the green. Mid-cap index is up 130 points. I think with the small cap index also in the green. Market breadth early, but it's indicative. 1,300 stocks are higher and about 300 stocks are lower at this point in time.
Well, HDFC Life is one of the big movers. It's opened up in the green with a gain of close to about 0.5%. But telecom catches your attention. Bharti Airtel is now the top gainer. The street is optimistic. The street is hopeful that there will be some relief on the AGR dues, which have burdened the companies for the last many years. So Bharti Airtel is now inching up, almost 1450 on Bharti Airtel, 1% gain. You have Coal India, so PSUs continue with their up move. Tata Steel is a big gainer. State Bank of India is higher. HUL, where they've announced the news about selling their water purifier business, AO purifiers. The overall impact is going to be less than 1% in terms of the revenues, but HUL is looking to focus on its core business. So they've sold their water purifier business and the stock is opened up in the green. On the losing side, pharma takes a bit of a backseat. So Dr. Reddy's, Apollo, Divi's Laboratory, all of them are down between 0.5% to 1%. Hero MotoCorp, L&T, Nestle too under pressure.
Well, a few stocks are flying away actually this morning. We had the positive news flow coming in on Century Textiles. So that stock, in fact, is up and about. The Birla Estates has secured a 71-acre land in Gurugram. The GDV at around 1,400 crores. So that stock is up and about. Hatsun Agro, summer season has aided the ice cream business. The margins up 280 basis points. The street likes it. That stock is flying away in trade today. A couple of other notable movers. Oriental Carbon, well, that stock is up close to around 5%, moving on rather large volume, so highlighting that one. HPL Power has been a big mover. That's up even in today's trading session, up more than 5%. JP Morgan, they've initiated an overweight call on Bharti Hexacom. Well, that stock is up with the target price, in fact, up around 1,280. This I'm talking about Bharti Hexacom. So let's get that up for you. For the time being, the stock opens up with a gain of close to around 4% or thereabouts. So good going on a couple of these names. And Angel One, I think, as well. Rima just pointed out, I think that one, that as well has opened up in the green.
Okay, so 35 points higher on the index is what we have. And we're at about 24,617 at this point. Just a few other names, right? And Chennai Petro is the biggest volume-led gainer with a 7% pop. Stocks at about nearly 1,160. Apart from what Nigel and Rima mentioned, there is MOIL, there is manganese ore, which is starting 4% higher, 550 on that one. MTNL is coming up with large volumes, 52 rupees, 6% higher on MTNL. I think Adani Green is up 3%, has got decent-sized volumes for this point in the day. That'll come up. Zentech has had a one-way rally recently. I think it's at a new high, 3% higher. It was up 5% yesterday. This OCCL, I think Oriental Carbon, 17.5% higher. Hardly ever comes up on the radar at open, but 352, and it's got volumes to back right now. Look at that, 3.5 lakh shares. ISMT is up 4.6, 4.7%. Dredging Corp is up 5%. Raymond is up about 4%. So there is lots and lots of stuff going on. Motilal Oswal Financial Services is up 4%. Stocks coming through with gains and some volumes, not much. So this is essentially, what is up on volumes right now. On the downside, IREDA is down 4%. RVNL is down 2%. Geofinance is down 2%. It's got some volumes. Ircon is down 2%. Jupiter Wagons is down 6%. So that's a large cut, 662 on Jupiter Wagons. Oil India is down about 2.5%. Godfrey Phillips is down 2%. Texmaco Rail is down about 1%. Jyoti CNC, I can spot. Manappuram is down a little bit. But, volume start to thin out if you go down the list. But this is the bulk of the activity, right to the word go, and how the opening sort of levels are coming through at this stage. I mean, the index is up about, 26 odd points, 28 points, 24,600 plus at this stage. We have Gautam Dugar, who is with us. He's Head of Research, Institutional Equities at Motilal Oswal Financial Services. Gautam, great to have you with us here. Thank you very much for your time. I just want to start with what you're telling clients about the budget and where should they really focus on in terms of announcements and which sectors could get a push, a meaningful push. So let's start there this morning, Gautam.
Sure, Prashant. Good morning. So as far as budget is concerned, we think there is broadly going to be continuity in the direction of policy making, which is basically the overarching focus on the infra, capex, manufacturing and PLI agreed. At the margin, as we have seen in some of the recent state budget like Maharashtra, the government could use the extra bounty of about 1.5 trillion from RBI dividend to provide some sort of relief at the bottom of the pyramid, whether through tax cuts or through some other consumption giveaways. We don't know yet, but that's a possibility because in another 2-3 months, we are heading into a big election calendar again as far as state elections are concerned. We've got Maharashtra, Haryana and Jharkhand in November. And then I think after another 3 months, you have Delhi and then next year you have Bihar. So, the political calendar is always very hectic in that sense. And I think a government does have that leeway to sort of use these 1.5 lakh crore extra money to create some sort of a buoyancy at the bottom end of the consumption pyramid, because that is one area which has been suffering for last 2-3 years, as we have seen, whereas capex, infra, industrials, that segment of the economy has been doing quite well. Rest of the things, there's no point speculating much about it because we have seen now for last 8-10 budgets, we keep speculating this will come, that will come, but eventually it doesn't matter. If you look at markets, they have broadly followed the path of the earnings, especially the large caps. Mid cap and small cap obviously have been completely dealing from the earnings, underlying earnings trajectory. So, yeah, I mean, it will create an impact for a couple of days. And then again, I think markets will be back to fundamentals and earnings. So, yeah, I mean, that's how we are looking at budget right now.
Hi, Gautam. Good morning and good to see you, Ben. So it's all about earnings. What do you make of a couple of those IT companies that came out with this set of numbers? The street likes it, but they bid up the stocks in anticipation of better than expected numbers. And that's precisely what it is. How are you all placed on tech? What do you make of the earnings and preference in the IT pack?
Sure, Nigel. Good morning. So as far as tech is concerned, we've been underweight for some time. We now moved it to overweight with this quarter's preview and model portfolio revision that we've done. So we are now back to overweight position on tech. Yes, earnings have been decent, been in line broadly. HCL Tech has been a slight beat because of the slightly higher other income. But that's where our preference lies. In fact, if you see, we've now given a target multiple to HCL Tech, which is at a 10% premium to Infosys. This is the first time that we've done it, right? So as far as tech is concerned, we are now turning incrementally more positive than where we have been, not because we are expecting any significant pickup in earnings, but broadly, the valuations look okay in the context of rest of the market. Second, there has been 3 years of a very lackluster growth there. If you look at the earnings growth of tech that we cover, the last 2 years, CAGR is hardly 5%, whereas Nifty has given close to 20% sort of a CAGR in the last 2 years. So tech has underperformed on earnings front for last 2-3 years now, and stock prices also, keeping aside the mid caps in IT, which has done phenomenally well. The large cap IT has still been trading in a very decent and a fair band of valuation. That is what has prompted us to raise the weight on tech from underweight to overweight, within which we have Infosys and HCL Tech as our preferred large cap bets in model portfolio. And then incrementally, we have added Persistent and L&T Tech in the model portfolio. That's where we stand on IT.
Okay. Gautam, hi, morning. Rima here. So what are the other big portfolio bets or the changes that you've made to your calls in the last 1 month? IT is one, you spoke about it. What else?
So 2-3 big changes we've done, Rima. One is on pharma, where we've gone from neutral to marginal overweight now. Second, we have brought auto down from overweight to underweight. The stocks have done phenomenally well there. Names like Sambardhan and all, which we had added in model portfolio a quarter back, are up 72% in a quarter. And M&M, which is part of our model portfolio, still is up 40-45% in last 3 months. So auto has done phenomenally well. And that is where we expect earnings to moderate now after 2 years of very sharp earnings growth. So which is why we have taken auto down to underweight now. And consumer discretionary remains a big overweight for us. We have almost 11 consumption stocks in our model portfolio and only 2 staple names, which is Lever and GCPL, which we've added now by replacing IDC. As far as discretionary is concerned, we have a whole host of names. names like Titan, DMart, Indian Hotels, Zomato, all of that. And then on the mid-cap side, we have Kalyan, KEI, Metro, Silo, all those names. So basically our tilt for last 2.5 years has been towards discretionary, and we've been underweight staples. Marginally, we have made some tactical changes in anticipation of some sort of positive announcements around consumption. Let's see how that pans out. At a margin, rural is also showing some signs of pickup of the decent pickup in monsoon, and management commentaries around staple companies have also started turning slightly better after fourth quarter results. So that is discretionary, and then industrials remain a big overweight for us, whether it is capital goods or real estate. We've continued with our big bullish stance on real estate even now, and then largely private banks is underweight and PSU banks is overweight. So that's how we are overall positioned on the model portfolio side.
Okay, all right. Gautam, what about the real estate theme? You know, some of those stocks have done very, very well. I think a couple of names you all have been positive as well on. You had Shobha, Prestige that did well. And now you have, some of those Mumbai-based realtors like Suntech Realty, which all have been positive on as well. They are playing catch-up. How are you all placed on the real estate theme? And in your pecking order, how does it go?
So, Nigel, we've been positive on real estate for more than 2 years now. I think real estate, which has languished for almost a decade in terms of cycle, is seeing a decent pickup in the last 3 years. And I think we are still in the middle of the cycle. I do expect the developers to behave more rationally this time. And, price growth will be slightly moderate in our view. We think the cycle can get prolonged a little bit. And the kind of money that a lot of these developers can make by prolonging the cycle will be much higher compared to what they get by raising prices too high too soon. So that is a phenomenon. That's a fundamental thought process that we have on real estate. As far as our picks are concerned, we've been holding Godrej property from 1,000 rupees. We still continue to hold it. As you mentioned, we hold Shobha. See, Nigel, real estate is a very top-down macro sector. When sector does well, all the stocks will do well. So whether it's a Prestige, which has been our CY23 top idea, and now Shobha, which has been our CY24 top idea, irrespective of the name that you look at in that entire real estate pack, it has done well in the last 2-3 years. And we expect the cycle in both real estate as well as hotels to continue, because the demand-supply gap is still in favor of demand right now. And we haven't yet seen the beginning of a rate cut cycle. So hopefully, as and when it happens, maybe in CY25, it can act as an additional trigger for some of these deep cyclicals.
Gautam, so especially for markets like now, I'm not saying that it is the case, but are there any other risks? For example, too much, we talk about whether valuations in stocks are getting a little out of hand, but should one start to ask the question for real estate? Especially, but it's very micro market, right? It's not one exchange like stocks. What's happening in Gurgaon is very different from what's happening in Mumbai and other markets, etc. But some have been sort of raising the prospect that especially in a market like Gurgaon, investor, broker demand, etc. is driving most of this price appreciation now. These 2-day sales, everything sold out, and things like that. Does that worry you at all, that the proportion of end-use demand perhaps is coming off and investor demand is rising? At what point does that become a worry?
So, Prashant, we must be asking questions about all sectors all the time, given where the markets are trading at right now. More so for sectors like real estate, you have your defense and railways and all of that. So, to your specific point on Gurgaon, definitely that market is in a very different trajectory altogether. So, you have to be extremely cautious on companies which are direct play on that market, right? There's no price for guessing that market has become completely exuberant in the last 2-3 years. You've mentioned a couple of points around that, flats getting sold within 24-48 hours of launches and all of that. So as an investor, we have to be extremely cautious around the risk reward inherent in some of those stocks. The broader point I was making was last 2 years, you've seen very strong pickup in pre-sales and business development. If you look at the total pre-sales number of the top 10 real estate companies which are listed, you will see that the pre-sale CAGR has been more than 30%. Business development has been going on pretty strongly, 3x, 4x growth out there. Now, some of that pre-sales business development that has happened 2 years back, they are now getting reflected in the P&L. For example, this quarter itself, we're expecting a 40% growth in profit in real estate companies. I know profit is not an operational driver for this stock prices. They depend more on pre-sales and some of the launches. But the fact of the matter is, whatever development that you've seen in the last 2 years is now getting converted into profits and cash flows. And that's where I said, from a top-down perspective, real estate remains, to us, very attractive. Yes, in between, there could be rounds of corrections, so that you'll have to bear with. I mean, just look at some of the other sectors that you just spoke about. I mean, in the market, there are sectors like defense, where market cap has gone up from 1 lakh crore, 3 years back to 11 lakh crores now. Railways, again, market cap has gone up from 1 lakh crore 3 years back to 7.2 lakh crores now. Well, the profit cumulatively has gone from 15,000 to 30,000 crores for both these sectors put together. So on a 30,000 crores of profit, railway plus defense today, the entire listed stocks in these two sectors are trading at a market cap of 18 lakh crores. So that's a trailing P of 60x now. 4 years back, the trailing P was 12 times. So P itself has gone up 5x, Prashant. So you have to obviously be very cautious, especially in mid and small caps, cognizant of what you're buying and what you're paying for.
But what's the overall sentiment? Is it just still upbeat, or do you think, given the overvaluation that we're seeing in certain pockets, you are seeing euphoria set in? Because you also look at valuations, you compare it to the global markets, you track the flows picture in the Indian markets and how the weightages of DIs and FIs is changing in sectorally. Any interesting trends that you've gleaned from there?
So Rima, see, in every bull market, you will always find excesses in some pockets, some sectors. That been the norm. Whether you look at 2003 to 8 or any other bull market in the history, you will always find some sector going into excesses. As far as India is concerned, if you look at Nifty, which is broadly 50% of India's market cap now, it is trading at 20 times, which is on a 10-year basis in line with the 10-year average. Now, obviously, you can dig deeper and say within Nifty, X of financials, the rest of the sectors are trading at expensive valuation. That's fine. If you look at, we've done a good market cap comparison versus profit comparison on trailing 5-year basis. If you look at the last 5 years, Nifty market cap has compounded at 18%. And that's how the Nifty profits have also compounded. So they've kept pace with the market cap. But X of financials, the Nifty profits have compounded only 13% and market caps compounded 90%. So this is a clear-cut re-rating which has happened in the X of financials basket. And that re-rating is even more pronounced in mid-cap and small caps. If you look at the same data for mid-cap market cap is compounded at 27% versus the profit compounding of 17%. And same number for small cap stands at 8 and 28%. So yes, there are pockets where valuations are obviously offering you no comfort. But then that's where you have to dig deeper and do more bottoms up as far as projections and your cash flow analysis is concerned. The second point that you're talking about compared to global markets, do remember, Rima, that India right now on both macro and micro is offering the best combination, 7.5%, 7% GDP growth and close to 15-16% profit compounding for next 2 years on a base of 23% that you've already seen for last 4 years. The important ponderable is where does flow stop? Because that has been a very important part. Because you look at the first 6 months of CY24, the total flows are $28 billion, which is 30% more than what you received in entire CY23. And if you stretch that comparison to, let's say, last 30 months, which is beginning 1st Jan 2022 and ending to 30th June, so 2.5 years. In that 2.5 years, total cumulative FI flows are just $4 billion, out of which 3.5 came in June. But corresponding DI number against that 4 billion is 82 billion. So yes, in a bull market, till the time your flows are very buoyant, the underlying valuations can get delinked from earnings in the short term. But over a period of time, they have to catch up with earnings. Either the earnings have to catch up with the market cap, else the reverse will happen.
All right, Gautam, thanks a lot for joining in and filling us in with all of those details. I like the report you put out on the retail rhapsody, as well as the important point they're making. Everyone's talking about market cap going up, but even earnings have gone up at a similar pace. So that's why, there's not been, the markets are not as expensive as someone thinks. Well, let's move on then. Let's talk about the infra sector now. With the union budget due next week, what are the key expectations from this space? To discuss this, we are joined by Mr. Vinayak Chatterjee, founder and managing trustee of InfraVision Foundation, as well as Mr. Padmanathan, the senior director of Crystal Market Intelligence, as well as analytics. Thanks a lot, gentlemen, for joining in, and good morning and welcome to the show. Well, let's start with you, Mr. Chatterjee. You're calling for a bigger boost in terms of spend. Could you give us a couple of numbers out there? And do you think the government has enough of fiscal headroom to go ahead and push the accelerator here?
So let's talk about the headline numbers. If you have when you track the last few years, you would have seen that year on year, the outlays have increased by 25 or 30%. And that has been the primer of the economy and GDP growth in a situation where, as we all know, private capex has not been up to expectations. That trend is continuing, and the maths is very clear. For example, a very senior functionary in the finance ministry during the post-budget interactions last year shared in a media interaction that they have a confidential internal report in the Ministry of Finance that a rupee spent on public expenditure on infra and public works results in 3 rupees of GDP, whereas 1 rupee spent on measures like direct benefit transfers, DBT, results in 90 paisa of GDP growth. So the maths is very clear that if you have to constantly keep priming the economy with public outlays, which is the case here, then you need to keep investing in infra at the same pace, which means a 30% increase. Now, the last full year budget was 10 lakh crores. I am discounting the interim budget at 11.1, which I thought was just a holding operation. But if you take the last full year budget at 10 lakh crores and you put a 30% increase on that, my personal expectation is that we are likely to see a 13 lakh crore budget from the union government. And the thumb rule there again is that if the union government spends X, then an equal amount is spent by 3 other constituents, which is private sector, extra budgetary resources, and states. So you're likely to get a 26 lakh crore total infra spend in the economy. And the maths, I mean, I'm not delving into detailed maths now, but the maths is very clear. And that is going to keep priming the GDP at expected levels of 7.5 and 8% growth. Now, if you reduce the infra outlay from 30% to say 10 or 15 or 20, then you have to be mentally prepared that you're not going to get a GDP revving up at 7.5 and 8. You're going to see a drop in GDP. So the broad number, in conclusion to your question, is that my expectation is that with the need to keep employment going, to keep the GDP primed to get 8% growth, the minimum expectation is that the government will have a 13 lakh crore outlay, 10% over the last full year. Over to you. 30% over the last full year. Sorry.
Right. Good morning, Prashant here. Sorry, Mr. Chatterjee, just to, you said you put out a number of 26 lakh crores as well. What was that?
See, the thumb rule is that when the central government spends X, then 3 other constituents together spend an equal amount. So if the central government expenditure is a lead. So if the central government spends 13 lakh crores, another 13 lakh crores will be spent by the combination of states, extra budgetary resources, PSUs, and private sector. So 13 will be matched with 13. You will get a 26 lakh crore outlay for the total, infra spend in the economy. And that will keep priming the economy to an 8% growth.
In the interim budget, what was that? What was the sort of number? The 13 lakh crore that you...
1.
Sorry, 11.1.
Yeah.
Okay, got it. Let me just welcome, Jagannarayan Padmanabhan as well. Mr. Padmanabhan, good morning. Good to have you with us here.
Good morning.
So, as you heard, Mr. Chatterjee, of course, said the interim budget was a holding operation, and this is going to be a big one. And they have, things have changed, right? There's an RBI dividend and tax collections have been robust, etc. Well-known facts. First of all, do you think that is going to be the case? Because, if you look at the interim budget as well and look at specific sectors, that is FY25 budgetary, the BE number, railway capex was projected to grow 2%. These are all interim numbers, 2%. Road was supposed to grow 3%. Spend on road, spend on defense 9%, housing and urban affairs 3%. So there was a sharp slowdown as compared to the last many years, 2022, 23, 24. So would you align with what Mr. Chatterjee is saying that, that was just an interim number and we'll get a much larger allocation now comparable to the last few years?
Yeah, so thanks for having me here. I think from a context perspective, we are operating in a fairly larger base. So pump priming has been happening for the last 5-6 years in the infra space specifically. And I think just to cut that into multiple pieces would be important. So roads and railways garner close to about 50% and above in the overall infra spend. I think what Mr. Chatterjee also alluded to is that the previous year was 10 lakh crore, which moved into about 11.1 lakh crore. So that itself was, in a way, a moderation, and his expectation is that 30% growth. So the interim budget did have a pause in terms of the overall growth. Historically, there has been between 25 to 30% in the infra spend. Yes, we do expect a similar kind of a jump up in the spend, which will happen, and it will go primarily to these two sectors, which is roads and the railways. And we also see and the ability to absorb such huge capital is also there only with these sectors. So given that context, I think this is important. The other ministries that you mentioned, actually, the highest I think is about 50,000 crore tops, which will go into the capital expenditure. The revenue expenditure could be higher, but the capital expenditure is tops 50,000 crore in any of the other 5-7 infrastructure base which is there. Yeah, so hope that answers. Yeah.
Mr. Chatterjee, can we talk about sort of 2 or 3 schemes which you think will receive the maximum attention? Because I think markets will also be interested in understanding that. There was, of course, the entire water theme, which we've discussed with you before. Just 2 or 3 sort of flagship schemes or areas which you think will see the maximum attention. Yeah.
Well, let me speak about the number one policy intervention which the economy sorely needs. And I have been arguing this on your channel and other channels quite vigorously. We see that a product like cement, which is both an Aam Aadmi product as well as the key infrastructure intermediate, accounting for a large portion of the cost outlays, is taxed at 28% GST. The 28% is what is called the sin tax slab. It defies rationality why an infrastructure intermediate, as well as an Aam Aadmi product, a person who is converting his mud house to a cement concrete house, why should we continue with a 28% GST on cement when it itself is one of the primers in terms of cost? So while the budget itself is an arithmetical exercise, we all know that it is also a platform for announcing key thinking of the government and imminent policy changes. So my request to the FM and the Finance Ministry over the last 2-3 years, and now it gathers momentum because of the revenue buoyancy that we are seeing. The government can do it now. Their budget speech should make a reference to the fact that the government is conscious about reducing a 28% GST on cement down to about 12%, and that the reference should be that the matter should be taken up at the GST Council. It will have far-reaching ramifications on the economy, both in terms of leading to a boost in the consumption of cement and construction, as well as, since government is the largest spender in infrastructure, a reduction in cement will make its budgets move that much more forward. It can do far more in a given budget. So all trends point to an economic intervention on cement GST, which is crying for attention. Let me stop here because we can talk about many sectors: water, rail, road, irrigation, rural, urban. But let me stop here because I think this is an important point for all of us concerned with policy making in the budget.
Mr. Jagannarayan, specifically, what are you expecting for the 2 states? One is, Andhra Pradesh, and the other one is Bihar. Given the political compulsions and the way the election is panned out, there is talk about a special status being given, extra support given to these 2 particular states. What is your expectation? What might come out in the budget?
Sure. So before that, can I just add on to what Mr. Chatterjee talked about the schemes part of it, if you allow me? And I think which will be a very important one in the overall scheme of things is the roads which have been getting a fair share, which was driven by the Bharatmala Pariyojana scheme. And I think that was the question which was also asked. In the last 4 months, if you were to see, the awards has been really at a pause. It's been really muted. And the first 2 months, due to election, The next 2 months, the awards has really been very muted. I think a couple of 100 crores, 100 kilometers at best has been awarded in that. While the traction for in the same period should have been close to about 500 to 600 kilometers. And the primary reason is from the Bharatmala Pariyojana scheme has not got the cabinet approval as such today. So my sense is in the going forward, this will be a primary area where the government may make an announcement in the budget for a revamped and a higher allocation could go for this particular scheme, which will then be for a medium term the next 5 years, which will be the phase 2 part of it. And specifically here, I think the capital expenditure, we are talking about lakh crores and all of that. The focus has to move towards from just build out into the services part of it. And when I say services, it is more towards the safety aspects which are there, either on the road part of it or on the rail. So I think a lot of focus which will happen, passenger amenities on the highways part of it, which would be there. On the railways, we could look at something on the Kavach and the security and the safety of the passengers part of it. So I think a lot of this from a medium-term outlook, because of what has got stopped before, could get announced in the budget specifically. And then an enhanced Bharatmala Pariyojana scheme is what I'm expecting in the forthcoming budget. Specific to the two states, unfortunately, I don't track Bihar or Andhra Pradesh on a state level part of it, but suffice it to say, from an infra build out, the states, as Mr. Chatterjee also pointed out, have been matching similar to what has been done by the center. And I'm expecting similar thing to continue going forward at the state level as well. So the focus there would also be on the hard infrastructure build out. We could also look at the rural roads to be revamped, and because that's a significant job generation part of it, which will be the theme for the government. The food chain and the agro part of it is also something which needs to get augmented. So schemes on this nature, specific on the infra part of it, is what we could look at.
I think we barely scratched the surface, but gives us a sense to begin with, and maybe we'll have one more round of sort of a pre-budget chat with both of you. But interesting observations. Mr. Chatterjee and Mr. Padmanabhan, you might want to stay on. We're discussing housing on the other side as well. We've got a housing finance company to ask about expectations there again. I mean, this more or less infra. Thank you very much for joining us here on the program. Thank you for joining us, and really appreciate your time on CNBC TV 18. We'll take a break. We are back, and as I said, we'll be joined by the management of Aadhar Housing Finance with, what they are watching out for as far as budget 2024 goes. Stay tuned.
Welcome back. Let's continue our coverage and set the tone for budget, which starts next week. Aadhar Housing Finance is the company on our radar. The company listed on the exchanges just a couple of months back. And the management that time had said that they're confident about sustaining a 20% growth. But to talk about growth and what the expectation from the budget is, we have Rishi Anand, MD and CEO of Aadhar Housing Finance with us. Mr. Anand, thank you for joining in. This is Reema here. First, lay out the expectations. Now, you've carved a niche for yourself in affordable housing. That's expected to, have a lion's thrust in the upcoming budget. What is your expectation? Specific schemes, if you could lay that out for us.
Right. Thank you, Reema, for having me back. Yes, I see a lot of traction happening on the pre-budget discussions. I was hearing a while back, Mr. Chatterjee speaking about the cement industry, etc. As far as housing goes, housing broadly, is an economic growth driver, which all of us know. But it also, if you look at it, it impacts various sectors, right from the housing finance companies that are the cement industry, the steel industry, and it is an employment generator. So housing overall, drives that strength of economic growth. Now, when it comes to expectations, I think the industry as a whole has laid down multiple expectations, right from looking at income tax benefits, enhancing those limits, separate sections. We have talked about redefining the priority sector limits in metros and non-metros. We have talked about redefining the EWS LIG's income limits. And more importantly, and the most talked about, the Pradhan Mantri Awas Yojana scheme.
Okay. You know, on the Pradhan Mantri Awas Yojana specifically, can you tell us, you know, what is it that you're expecting?
Rima, this scheme was, if you recall, and I had mentioned this earlier also, this scheme was available until March 22. And in the pre-budget announcement, interim budget announcement, the FM had indicated the scheme should be back with better contours. Having said that, there are broadly four portions to the PMAY scheme. One, and the most important one, is the CLSS, which is Credit Linked Subsidy Scheme. Then we have the second section, which is affordable housing in partnership. We have beneficiary-led construction, and finally the in situ slum development. For a moment, let me talk about only CLSS, because that impacts the end users directly through intermediaries like us. If you recall, the CLSS subsidy scheme had a limit of 2,67,000 per end user. I think the demand or the request to the FM has been to enhance this 2,67,000 to about 3 lakh rupees. And more importantly, in the previous scheme, the extent of coverage was only 21,000 locations, and there has been request from industry bodies in the housing finance to enhance this coverage to more locations, at least minimum of 50,000 locations.
Okay, so the limit goes up, right? I mean, from 2.67 lakh
to 3 lakhs. That's the request. That's the request.
And of course, number of locations where this is in use, that also should be more than doubled. That's been the request.
That's right. That's right.
Yeah, and you've kind of made, the industry, I'm assuming, has made these representations during the pre-budget consultations.
We have, at multiple forums, we've made these representations, Prashant.
Okay, got it. You know, if there is widespread expectation that since this is an industry with multiplier effect, and the government is looking at ways to do that, to exactly do that, what kind of impact can we see if, say, as you yourself said, these specific demands are met on the CLSS side? I'm not even talking about the other three aspects of the PMAY scheme. What kind of impact can it have on credit growth for companies like you?
See, Prashant, if I can, quote some numbers which will be very helpful for the audience when it comes to Aadhaar housing finance. In the previous scheme, we extended a subsidy of approximately 1,800 crores, which impacted lives of approximately 82,000 individuals, which is approximately 50+% of my housing finance book. So that is the kind of impact we are talking about. 50% of a book of 21,000 crores gets impacted by the subsidy scheme, even if it is 2.667 lakhs to the end user. If it gets enhanced and if the requests are met, I am falling short of words, but it should be beyond 50% of my additional book as we go ahead. And so for the industry.
Right, 50% of your additional book could be impacted. I mean, in the sense that you could
impacted.
It could give a boost to that much in terms of credit that you make.
That's right, and I'll tell you why. Because companies like us, we cater only to the EWS LIG segment. 72% of our book happens to be in the EWS LIG segment. Hence, the penetration levels are very high.
So, what can growth rate get boosted to if we do get this incremental benefit coming in the budget?
That's right. It gets boosted completely.
No, by how much? Do you want to put some numbers to this?
So on an incremental basis, we are looking at anywhere between 10 to 15% of my incremental business getting enhanced by this scheme.
And Ms. Anand, what are you factoring in terms of AUM growth as it is, irrespective of whether this comes or not for the coming year, FY25?
Nijal, in the last interaction also I indicated, last 2 years we've been growing at about 23-24% on our AUM. And given the strong demand, the benefits that are going to come up after the budget, I don't see any reason why we should shortfall of 23-24% incremental AUM growth.
And if there are some tweaks in the budget, then maybe, in fact, you can do even better than that.
Touch wood, yes, definitely.
Okay, all right. A couple of quick aspects. You raise some money via the QIP route. How does it change things, your ratios, as well as how much does it reduce your cost of funds?
From a ratio perspective, the only ratio that gets impacted for a couple of years is the return on equity, which is from an 18.4 as last reported in March 24, falls to about 17.4, 17.5% for a couple of years, and we should be quickly back into the 18% plus ratio.
Okay, and cost of funds?
So cost of fund will not see a major impact as we move ahead. I think anywhere between 20 to 30 bips impact is what we are seeing.
And you're looking at NIMs of around 8 to 8.5%, right?
We continue to look at 8.5% plus NIMs.
You said you expect the number of locations to increase under PMAY. Currently, it's 21,000. In the budget expectation or the representations that you've made to the government, how many locations do you now want covered?
We should look at, and when we talk about these locations, Rima, we are not talking about rural locations at all. We are talking about, roadside towns, small talukas, small districts, and anywhere between a good number to have under this populist scheme should be about 40,000 locations.
So doubling it.
That's right.
And how has asset quality been for you? It was under control when we've spoken to you last. But in the last 3 months, has there been any incremental stress that you've observed, or has it gotten better?
So I would say, it is a very seasonal kind of asset quality movement that we see in our industry, and we are completely on the track. As you remember, and you rightly said, we closed the year March 24 at 1.08% GNPA numbers, which are well within our budgeted discussions.
All right, we'll leave it there. Mr. Anand, great to have you with us here. And I hope we can have you on the day of the budget. Once the announcements are out and the speech is made, it'll be lovely to get your reactions to what is announced. And hopefully some of what we discussed does come through for the sector. Thanks very much for joining us. That is
very hopeful. Thank you, Prashant.
Thanks very much. That's the management of Bazaar Housing Finance with some perspective on hopes for the housing finance sector. We're up 50 points on the Nifty, 24,634, and things are looking pretty good. 1,600 stocks are higher. You've got about 700 stocks which are down, and it's not a bad-looking screen at all with lots and lots happening. Well, let's shift our focus to the auto sector now. First quarter earnings have started coming in. Bajaj Auto will be reporting its Q1 numbers today. It's expected to report a decent quarter. How will Q1 as a whole look like? Let's discuss this with Kapil Singh. He's auto analyst at Nomura India, and he's joining us to take some questions. Kapil, good to have you with us here. Thank you for your time. Good to have you with us here. Just a quick word, Kapil, on stocks under your coverage. What are the broad expectations, and what are you really watching out for clues to kind of look into the future as well?
Sure. Good morning, and thanks for having me on the show. So, first of all, coverage universe as a whole is seeing a pretty strong earnings growth. So, revenue growth, for example, for the OEMs will be around 10%, but EBITDA growth will be somewhere around 25%. So, still margins are going up, and this is going to be a strong quarter as such. Similarly, for suppliers also, we are expecting EBITDA growth to be somewhere around 25 to 30%. But the interesting thing to note is that now the inventories in the for the OEMs have filled up fully, and there are in fact discounts and deals on offer as well. So what we would look for going ahead is what kind of inventory levels OEMs hold, and what is the demand outlook, because there is a risk that margins could start coming under pressure from the second quarter onwards. And also, we have seen a little bit of inch up on the commodity prices. So these will be the two key things to watch out for as the earnings seasons begins from today.
So higher discounts, I mean inventory levels, right? Which kind of, and you said that from Q2 margins could come under pressure, and higher commodity prices, input prices. Which are companies most at risk from the first point? Higher inventory and discounts, and And to the point that you're saying that from Q2 onwards, margins can see meaningful pressure. Is that already the base case in stocks, or you think that's not really in the price right now?
No, I think it is to some extent factored in because industry bodies like FADA, for example, has talked about it, and SIAM has also acknowledged it. So I wouldn't say it's not there in expectations, but sometimes, if the inventory is too high, the discounting can overshoot. So these will be the risks, I would say, to watch out for. And it depends on how July, August, September kind of period goes as well. But what we are starting to notice is that industry growth has fallen to mid-single digit or low single digit kind of levels. And what that means is that overall industry is not growing high, whereas all the players are looking to gain market share. So there will be some kind of increase in discounts that I expect. Some of it may be visible in first quarter and some more visible in the second quarter. I would say that OEMs who manage inventory well may not really see this risk. But if they are not able to bring down inventory quickly, then there will be no option but to increase the discount. So I think across the board, we are seeing all the OEMs increasing either discounts or reducing prices. We have seen, for example, Mahindra and Mahindra, Tata Motors also reducing prices, but rest of them are increasing the discount. So it's in some way addressing demand problem and in some cases inventory problems.
Okay, hi Kapil, good morning and good to see you in. This is Nigel on this side. Let's focus on the two-wheeler space. I'm just looking at your top recommendations. You're still positive on Bajaj, while you're not so positive. I think you have a reduce on Eicher and you're neutral on TVS Motors. What are the expectations out there? And is that reduce on Eicher because of valuations, or do you expect growth to be relatively lower?
Yeah, so Bajaj Auto has been our top pick, and we are still maintaining that. They've been doing a lot of interesting things. I think besides the core business, where the portfolio has shifted more to the 125cc and above segment, which has seen higher growth, they have also done quite well in the electric two-wheeler space. And what we notice is that the volumes are ramping up pretty nicely as we see, for example, the month of July. They are already getting into mid-teens and closer to other leading players like TVS. We saw the launch of the CNG bike, which is another interesting proposition. And we are hoping that that product can also gain traction as we go forward. As far as some of the others are concerned, I would say particularly Royal Enfield you asked, I think the issue is of growth. We feel that at the level of valuation where it's trading, the growth may not be strong, and there will be some more market share pressure that would continue going ahead as well, because we will see players like Bajaj Triumph and Hero Harley continuing to ramp up, and that could put more pressure on growth going ahead as well.
M&M is your top pick in the automotive space. Recently, M&M share price came under pressure after that impetus for hybrid cars, a move which will benefit peers like Maruti. It's happened only in one state of Uttar Pradesh, but M&M stock corrected. Is this, how big a risk is this for Mahindra and Mahindra?
So look, I think as far as our assessment is concerned, we'll wait for a direction from the government on what the final implementation of the policy is going to be in Uttar Pradesh. I don't think the finer details are out as yet, but as we noted that it is, it's just one state which has implemented this policy, and even there are discussions undergoing that there may be some price limits, etc., as well, which could be imposed. So we'll wait for the final policy. But our assessment is that there are significant incentives or policy support for electric vehicles, and I do expect that to continue. So we have the PLI schemes for automobiles, auto components, for batteries, and I think taxation policy that India has is also very supportive. So now from next year onwards, we will start seeing cars coming out from all the players, including M&M. And I think we will see a pickup in electrification from 2025. At this point, the policies which are there, or the taxation policy which is there in particular, doesn't look, from the central government, doesn't look very supportive of hybrids. So that's the reason that we are not expecting hybrids to really gain share in India till there is any significant change in policy. So I think if you ask me, what I would watch out for is how the electrification picks up. I, at this stage, don't feel that hybrids will gain share with the current policy framework that we have.
Got it. Kapil, we'll leave it there. And thank you very much for running us through what you're expecting from Q1 and, of course, other allied industry issues as well. Kapil Singh, auto analyst at Nomura India, with perspective on the sector and specific names as well. We'll take a quick commercial break here. We'll come back. Okay, I think Mitesh is with us. Mitesh, for 10 o'clock calls. Mitesh, the market's up 60 points on the Nifty, but I think with stocks, there is a lot more action. What are your trades?
Prashant, Balrampur Chini is breaking into a fresh swing high. So buy here with a stop at about 445 and a target of 470 can be looked at on the upside. And the other one which I like is Marico. Buy here with a stop at 649 for targets of 680.
Okay, thank you very much for that. By the way, Reliance Industries has moved to the day's low. It's down close to about 0.6%. But on the way up, IT is moving up and PSUs. BPCL Coal India, top gainers on the Nifty. Get into a break. On the other side, we'll talk to Manisha Gupta. Welcome back. Up nearly 50 points on the Nifty. Today as well, the Nifty's gone and hit a record high in the early session. Yesterday, the high on the Nifty was 24,635. The high today was 24,650. So third consecutive day of records being made on the Nifty. But it's time now to talk commodities. Manisha's with us. Manisha, eye on gold?
Oh, it definitely is, yes. The overnight surge in gold prices has been quite on the stronger side. And from where we are trading right now, gold is not too far away from its all-time highs of $24.50 an ounce. The last 3 weeks have been on the positive side, and the gold prices only seem to be building up onto this one right now. So with the U.S. Fed now suggesting that the Fed will not wait for a 2% inflation to hit before they start taking an action, it is now a 90% probability that you will see the first interest rate cut from U.S. Fed come in for the month of September. That clearly has been supportive. And very interesting Citi report which says that the Fed rate cuts historically have led to 13% of gains in 6 months post the cut. So that is perhaps what the industry is readying itself for. Citi also has suggested that by mid-2025, the gold prices have all the ability to go up to $2,800 to $3,000 per ounce as well. If you look at this year itself, well, the gold prices have gained up by 16%. Silver clearly outperforming with 32% of gains in this year until now. This clearly has been an outperformer, not just within the precious metal, but within commodities and various other asset classes also. Interestingly, the gold ETFs globally also seem to be looking at more inflows in last couple of months now. The creative or the cumulative gold holdings in ETFs are still, though, at 2020 lows, but the last couple of months seem to be on the supportive side. Now, interestingly, what is happening in India is that you are looking at very strong gold imports and platinum imports as well. This is happening because you are looking at a loophole when it comes to imports here and multiple, multiple duty cuts as well for this one. So when you look at the platinum imports in past 4 weeks, they are higher than all of 2023. So what India has imported in sense of platinum has been almost to the tune of 11 million tons there, while all of last year was less than 10 million tons. Now, the government rule says that any alloy that is containing 2% or more of weight by platinum is seen as platinum alloy. But what the bullion dealers really seem to be doing is that they are actually importing importing gold in the garb of platinum there. So while the gold import duty is 15%, platinum duty is 5%, and with the bar which has 2% of platinum and 98% of gold can be imported, saying that it is platinum. So this is a loophole that we've seen happen in India, and what that has led to is that gold prices within Indian markets are now trading at a discount. So on 1st of July, gold was at a discount of around $10. It's at a discount of $34 an ounce right now if you were to buy gold in the open market there. We do understand that Delhi is working on this loophole right now. There are multiple duty that you can see in sense of gold imports, proper gold import under CEPA, gold import under FTA, gold from least developed countries as well. So this is something that we do understand the government is sorting right now.
All right, Manisha, thank you very much for that. Very interesting. Appreciate it. We'll take a quick commercial break here on the other side in our special pre-budget program. The segment, Lata will connect with Neelkant Mishra, member of the PMEAC and chief economist at Axis Bank, to discuss the big budget numbers to watch out for. Stay tuned.